doesn't need to be as long.
Okay.
I'm cool with that.
Yeah, I just want to learn about it myself.
Yeah.
Because I know there's been a lot of buzz on it, and it's not an area I'm that familiar with. We
Right.
are live, folks. As you can tell, I'm chatting with my friend Meb Faber here. I was going to do something corny and say the Meb, the myth, the legend, instead of the man, the myth, the legend, but obviously that doesn't work. For those that are watching this live on X, YouTube, LinkedIn, whatever platform you're on, we can see your comments if you want to engage during this roughly 45, 50-minute conversation. Don't hesitate to post on whatever platform you're on. This will be an edited podcast under Lead Lag Live on all of your favorite platforms. Apple, YouTube, Spotify. I always like to emphasize top 5% most downloaded podcasts out there because I just keep grinding them out as much as I can with great guests. This conversation is sponsored by Cambria. I am a fan of Meb's, been a fan of Meb's for a long time, and I'm glad that we're able to do these shows. So with all that said, my name is Michael Guyad, publisher of the Lead Lag Report. Joining me here is Meb Faber of Cambria, the Meb, the myth, the legend. Meb, I know I know it's boring to talk about yourself, but I feel like we should do a quick intro as far as your background, and then let's get into something unique that you're launching.
Yeah, man, known you for a long time. We manage Cambria, an ETF shop. We just had our annual holiday party last week. If you can see, I got a new swag SYLD Cambria hat. Listeners, if you're a long-term shareholder, hit me up. We'll send you a hat or a book. We just had the second edition of our old shareholder yield book come out. It's actually free if you can find it online, the PDF, or you can buy the paperback on Amazon. And I'm told soon to be an audiobook by yours truly. Anyway, we got 16 ETFs, almost $3 billion in assets now, which is crazy to think about. But we're based here in Manhattan Beach, California. If I'm a little hoarse, it's because I was hanging out with 27-year-olds and their dads camping all weekend. So I sound a little more like a frog than I normally do. But we're going to talk about all sorts of fun stuff today in ETF world. We're getting ready to launch a new fund next week. So pretty soon we're going to be at the 20 mark, almost able to drink alcohol here. We can almost vote, and pretty soon able to drink alcohol. But we'll dive into all these fun topics today, and maybe even include some year-end ideas at some point too.
I actually didn't realize you had 16 in total. I never actually counted the number. I'm blown away because, as you and I both know, that's not exactly a cheap endeavor. I'm curious from a business perspective. At what point do you consider closing a fund? And I'll tell you why I'm asking that question. I was taught about sunk cost fallacy at NYU Stern, right? It's like throwing good money after bad. It seems to me that it's kind of a hard decision to figure out when to close a fund, if at all. Typically, you'd want to close a fund if the performance is poor, but maybe the moment you close the fund, you're selling the low.
Yeah. So our goal is to actually never close a fund. And so, but also I feel like that's somewhat realistic. I don't mind the actual cost of the fund and just like having to pay for that. My belief, we often tell issuers and people thinking about launching strategies, I say you need to have a runway mentally of 10 years, but 5 years at the least. And that having been said, so we only launch funds that don't exist, or we think we can do much cheaper or much better than what's out there. And better, I put in quotes, right? That's a lofty goal. It's got to be backed by academic research or research we put out. We usually accompany every fund launch by a book or a white paper. That has to be something I want to put my own money into. So we're not just hucking all the ideas against the wall like a lot of our friends. I say that lovingly in the industry. So we only launch funds that I put all my public assets into our funds. That having been said, I'm also not like ostrich style, head in the ground, think that I know what everyone wants, because a lot of our ideas are wonky and different. So we're actually getting ready to close our first fund. And irony of all ironies, I don't know why, Guyad, I didn't hit you up when I launched this and you slap me and say, Meb, this seems like kind of a foolish ticker for this fund. And the ticker was FAIL, FAIL. And so it's our only fund that's failed. But the reality is this: we have a tail risk, a suite of funds. And our first one is very popular on US stocks. That's tail. And so we had 3 others filed, and FAIL being the foreign stock version. The problem with foreign stock hedging is nobody owns foreign stocks, right? So if you'd have told me that ahead of time, say, Meb, by the way, no one in the US owns any foreign stocks to hedge, that would have made a lot of sense. And so this fund never got off the ground because I think there's two reasons. One, nobody owns any to hedge. And if they do, they say, well, they've underperformed the US for 15 years. They're super cheap. I don't want to hedge them. So that fund, in my mind, I'm like, you need a whole full bull market outperformance period in foreign stocks before anyone wants this, unless they want to short it. And that's probably like, who knows, 5, 10, 20 years away. So
although I gotta tell you that, I mean, going back to that, you never know, you could be selling the low. It's like the stronger the dollar gets, the more we enter sovereign debt crisis territory.
Who knows, right? It's always who knows, and that's the humor of markets. I think one of my favorite piece I wrote this year was called "The Bear Market and Diversification," which is about how the S&P has just creamed everything else in the world, and it's free online, listeners. That piece was written in like Q1, and guess what? The market gods said, haha, S&P is up 30 after you wrote this. So it's like, I love the humor and randomness of markets. But at the end of the day, you got to make your best judgment. And we think there's some other ideas out there that probably deserve a seat at the table instead of fail.
All right. So you said it correctly. You're trying to launch funds that don't exist right now. That's a good transition into the new fund launch. Let's talk about TAX, which I don't know, is that a ticker that you want to see fail because nobody likes taxes? No, of course not, right?
Yeah, it's always surprising me what tickers are available when I type that in. These are actually a fund that I've had filed for like 7 years now, and it's based on an old paper we wrote, and the first title was really unfortunate. It was called something like, if you invest in dividend paying stocks, don't do this, like do this instead. Some like terrible title. And now we changed it to, is the best dividend strategy to avoid them, which is pretty inflammatory title. People love dividends more than anything on the planet. And so this fund is the first in a series of 3 funds. So we can talk about those in a minute. So there's tax, and then there's an endowment style allocation fund, a global shareholder yield, on and on. And while we're on tax, maybe we'll just talk about the strategy. What's really unique about these 3 is actually the seeding mechanism, which we'll spend some more time on. Tax is actually written up in the Wall Street Journal today. But the concept was, if you're a taxable investor, and most of us have taxable assets, I scratched my head about whatever the 10 years ago when I wrote this paper. And I said, if I'm a high net worth individual and I'm in a state like California, so theoretically, the last thing I want in my taxable account is dividends. Now, let's ignore the behavioral reason. Let's ignore if you actually want the distributions to go spend them. But let's say you're an investor who reinvests dividends. And to be clear, listeners, to get the total return of equities, that magical 10%, you have to reinvest your dividends. If you don't, you're going to get like 4. And I don't think most people understand that.
I'll tell you something real quick, not to interrupt, but I think it's fascinating that we're in a juncture now where it used to be the case. It's called mental accounting. People separate out the dividend from the capital appreciation, right? And even though its total return is obviously both. I'm blown away that now the industry has leaned into the idea that yield is separate. Right, that instead of saying that's a behavioral bias that has to be corrected, we have to think in terms of total return. It's now the exact opposite.
Yeah. And so I think most investors and a non-trivial amount of professional investors don't realize that if you have a stock and it pays a dividend, that the price of the stock goes down by that dividend. I think they think of it almost like a allowance or like a bond check. You're getting paid and it doesn't affect it's not a capital return. So anyway, listeners, you have to reinvest your dividends anyway. But let's say you could replicate the return. This is the thought experiment I did. I said, let's say you could replicate the return of the S&P, but not pay any dividends. Theoretically and mathematically, logically, as a taxable investor, you're going to have a higher return because you're not paying taxes on those dividends every year. And then I said, well, let's forget about S&P, which today yields like near low. It's like 1.3% or something. But let's look at like a high yield dividend strategy, 4, 6, 8, 10% historically, or something like REITs. I said, what if you could replicate the returns of the outperformance of dividends historically, high yield strategy, maybe 1% a year, but without the high dividend yielding stocks? How would you do? And so you can run all these simulations, and of course it matters. What's your tax rate? What's the tax rate in history? What is the dividend yield? What was it in history? But on average, this is like, it's anywhere from, tens of basis points, so already more important than the expense ratio, to multiple percentage points of outperformance if you avoid these kind of high yielders. So we said, hey, you could do a value strategy, quality, that kind of tilts away from the highest yielding stocks. And that's what tax is going to do. It's going to be 100 stocks, long only, value, quality. It's got a sprinkle of momentum, but basically it's shareholder yield, but without dividends. It does buybacks too. The key to all of this, and the academics haven't really acknowledged this enough yet, is that the vast majority of the asset literature about taxes and asset location doesn't acknowledge the ETF structure. And the ETF structure obviously lets you do turnover without paying capital gains. SPY hasn't paid a capital gains in 30 years, despite having turnover, right? And so once people acknowledge that, you can say, oh, hold on, indexing is cool because there's low turnover and that's why it's tax efficient. ETFs now, you can be active strategy, you can be high turnover, and it's tax efficient. It changes the game. And so I think you're going to see a revolution in tax location, tax strategies in the next 5 years. We've seen it. Our buddies at Alpha Architect launched Box, which is, I think, like almost 5 billion now. So people are clearly focused on taxes, as we all should be, because honestly, they're more important than expense ratios and more important than a lot of the alpha we're chasing because it's free and cheap. So I shouldn't say free and cheap, but it's a easy and cheap way to go about maximizing your returns.
Let's talk about that the seeding maybe a little bit on that further, because I think that's where it gets to be the most buzzworthy aspect of this.
Yeah. So this is what's kind of new and unique to most people. Now, it's not totally new and unique overall. So most investors, let's back up. If you're an investor, you've owned real estate, you've probably heard of the 1031 exchange. You buy a building and you own it for a long time and you decide to sell it and you buy another building. That's not a taxable transaction if you do a 1031 exchange, right? It's a tax deferral. You keep the cost basis. So this is how people have made generational wealth in real estate forever. Well, if you own stocks, let's say you've owned McDonald's or Walmart or Microsoft for forever, you don't really have that luxury. If you're in a taxable account, you sell it and you're kind of stuck. You got to pay the tax man. Now, there's something that's been around forever called the exchange fund. And this traditionally is only available to accredited, qualified, rich people. There's a lot of kind of rules. It's like Eaton Vance or Goldman. You have to contribute your stock. You got to hold it for 7 years. It goes into a fund. You got to have some private illiquid stuff. They're going to charge you probably 1.5% per year and another 1.5% up front. It's just like this kind of terrible structure, but it gives you a diversified portfolio in return. What we figured out with our friends at Alpha Architect and Title, and others are doing this now too, is that there's this new concept called the 351 exchange. Now, this has actually been in the tax code for almost a century, and you've seen over 100 of these in the last 5 years. The lawyer we're working with did his first one about 10 years ago. Traditionally, it's been something like you've seen all these transitions from mutual funds to ETFs. You've seen private funds to ETFs. You've seen someone take a basket of separate accounts to ETF. What we're doing, to my knowledge, for the first time is saying we're going to do this open enrollment. And so for the last 2 months, we made this announcement. We said, tell you what, if you want to contribute your stock portfolio to the seeding of our ETF, you now can for the first time. Now, there's 2 qualifications that are most important on this. First is the biggest position can't be over 25%. So if you got 100 million of NVIDIA, you can't give me 100 million. You could give me 25 million and then 75 million of something else. And then second is that anything that's above a 5% position has to sum to less than 50%. And so said more simply, you probably need 11 stocks to qualify. Now, what's cool is that ETFs are pass through. So if you own SPY, that 100% of that you could put in because that's a look through to the underlying holdings. And so you have this situation. And by the way, it's not a tax wash, right? You keep the tax lots of the original holdings. It's a tax deferral. So why would someone do this, and what's kind of the use case? There's two big use cases, for this idea. The first big one is what we alluded to in the beginning. If you've been invested in US stocks for the past 10 years, you're sitting on a 10 bagger. So let that sit in, listeners. 10 bagger, that's amazing. But that means if you just let markets float, you probably have a lot overweight US, but also overweight tech, overweight the really expensive companies. And that feels uncomfortable for a lot of people as the 10-year PE ratio now took out the 2021 peak. And so we got the final boss of 1999 sitting at 44, which we'll see if we can take that out or not. I don't know. But anyway, stocks are expensive. So people would love to diversify their holdings, but you hear the phrase, I can't, I'm stuck. And then second is direct indexing. And so for those people who have been doing a tax optimized strategy through Parametric or someone like that for 3, 5, 10 years, you know that once you're in that, after a few years, you have all these frozen positions. So you have these highly appreciated positions, you've taken all these losses, and now you're just kind of stuck. And so these are both great off ramps for those types of portfolios. We kind of launched a series of 3 totally different funds so that people could kind of pick and choose from the buffet. Fund 1 being a US stock fund, value, quality. Fund 2, diversified global strategy, kind of tracking the endowments. And Fund 3, one that is a global stock portfolio, and we're taking requests as well for maybe Fund 4, on and on. But it's a really cool idea, and for us, the last 2 months have been all about education. I think this first fund will be, the smallest of the lot as people get comfortable. Hey, Meb, you're not sending my money to Aruba or something. You're not going to mess this up. And then kind of watching to see for Q1 next year. Sorry, that was a long-winded, explanation, but that's 351 in a nutshell.
How many institutions, individuals, whatever, have enrolled?
So this will launch next week, and my guess is probably in that sort of 30 to 50 million range, probably similar amount of clients. We said for this first one, $1 million minimum, mainly just because we have 150,000 investors and obviously couldn't handle that many tabs in Excel. That would be a lot. And honestly, like we tell investors too, look, if you're younger, if you don't have a lot of income, you may want to be taking gains now, right? You may not want to be, deferring these to a time when you might have a lot more income and a lot higher tax rate. So it's all to everyone's, sort of individual sort of setup. But I think the key to this is everyone wants to understand the pipes of how this works. And also it excludes a lot of brokers. Schwab is fantastic. Fidelity is probably number 2. And then, all the other ones after that, it's sort of a one-off basis. And 99.999% of them have never heard of this. And so we've been educating not just end investors, advisors, but also branch managers and head of risk departments. And so I've done about 10 calls per day for the past month. If I'm looking a little sleepy, you can understand why. But I think you will see over the next 2 or 3 years, it'll be really cool. I think as software gets more efficient, as this all gets to be a more efficient process, I could see a world in 3 years from now where it's almost like a click button. Hey, do you want to seed this fund? Because you can always buy it after it launches. Tax launches December 18th. You can buy it that day, the next day, right? No problem. But if you wanted to seed a fund, it's almost like click a button, optimize the tax lots, contribute, you get the fund back, and it's a lot more simple. So I think in 2 or 3 years' time, people will hopefully this will be an option for not just our funds, but everyone else's too. We'll see if everyone else adopts it. It's a lot of work. The reason why I think BlackRock and State Street and everyone else hasn't done this is it's a hella lot of work, but manual, I should say, a lot of manual.
Yeah, it sounds very manual, right? You're not only are you having to do the education, but then you gotta the paperwork. You gotta follow up on the paperwork. You gotta make sure things are operationally going smoothly. I mean, yeah, it seems like a tremendous pain. But then again, if you're getting the seed capital that way, it's like, what's the lesser of two evils?
Sure. Well, and I joke we've launched 16 funds with no seed, so anything above 0 is going to be more than we're used to. So it's I think it makes a lot of sense. I think investors tend to put tax down the list of priorities until they file taxes or get their tax return, right? Like most people aren't necessarily thinking about this ahead of time when they should, because everyone is like 90% of their focus is expenses. What's the expense ratio? So they ignore things like short lending. They ignore things like, by the way, listeners, the ETF management fee is deductible, whereas a separate account is not. So if you allocate to a separate account on a taxable basis, theoretically, a 50 basis point expense ratio in the ETF, if you're a high net worth taxable investor, is probably equivalent to a 25 basis point expense ratio in a separate account. So I don't think a lot of people understand that either. But taxes, everyone focuses on expense ratio, but taxes is like such a low bar alpha, and in some cases, it can be a massive difference in return.
Yeah, that's certainly unique, and you're pioneering this, right, with Alpha Architects, and to the extent that it's successful, you're going to have a lot more competition, probably.
Yeah, I mean, and look, there's other groups have done it. Our friends at Tidal have done it, and I think historically it's been a little more bespoke. Somebody's like, "Hey, I got this fund. I want to pick it up, put it into an ETF." I think you're going to see more and more enrollment. I joked on Twitter, half jokingly. I was like, "Look, these direct indexers, they should go buy some of these white label shops or advisors, because this is a perfect off ramp for them. And if they don't, all the assets are going to come out of direct indexing into these ETFs." There's a lot more kind of like at the fringe and really cool ideas that you can probably optimize and try out in the future. We're trying to stay pretty basic for the first couple of funds. And certainly we got a lot of education and literature on our website. If you're interested, download. We did a few podcasts and webinars on this topic, and certainly we'll have more coming out as well.
Is there anything else that you are directionally thinking about that you haven't filed yet outside of this? That
Yeah. I'll tell you the three funds in the series. So, first is this tax ETF. And again, it should have a near zero or near zero dividend yield. This fund is 49 basis points. And if you think about it, it's like Berkshire is like kind of a perfect target stock that might be in this fund, where they don't pay a dividend. They've never paid a dividend really since inception. Buffett jokes that the one time they paid a dividend, he jokes he was in the bathroom. Like, he's like, what was I thinking? But they do buy back a lot of stock, but he gets it. He's like, I don't want to pay taxes on my Berkshire dividends. Like, that's crazy. So this fund will look like that. And most people, when you think of the marketability of, hey, this is a low, no yielding fund, who's going to want that? Well, we'll find out. I think a lot of people may want this type of fund. Fund two is for the person that says, hey, look, I have these highly appreciated stocks, but my portfolio is like 70% US stocks now, or 80 or 90%. I need to get out of US stocks, or I want to diversify into something, an asset allocation, something global that's lower volatility, probably lower drawdown. And so for us, we're doing an endowment style ETF. The theory being you can replicate a lot of the returns of an endowment strategy. It's my first book that's 14 years old at this point, Ivy portfolio, that you can replicate these with liquid ETFs now. So global stocks, global bonds, global real assets, some other alt strategies mixed in. So the ticker on that one will be ENDW. That's hopefully in probably March. So we'll start the enrollment process after the new year. So first week of January, if you guys want to contribute to that fund, let us know. We'll get you in the queue, and that one should launch. And that's meant to be, you can contribute other assets. So fund one, we're only accepting US stocks and those similar type of positions. We don't accept your micro cap or your pink sheet stock. We are not accepting your Bitcoin. Fund two is a little more latitude about global. And then fund three will either be this global shareholder yield, so global stocks, or a global equal weight. We haven't decided what order those are coming in, but those will be the next ones in order. And then we've actually had a handful. I just got off a call right before this, where it's an RIA. They're like, look, we have multi-billion in assets. We have a few $100 million. could we work with you to design a strategy that we could launch and be the kind of key foundational seed for? And we say, sure, as long as it's something we can get on board with. We don't want some harebrained, uh, quadruple short micro strategy put right with a, Brazilian small cap tech stock overlay. Like we don't want something like really odd, wonky, but something that we could get in, theoretically and academically would be okay with. So if you're a big RIA that wants to talk to us about that too, we're happy to chat. So that's what kind of next year looks like. We actually have a couple books in the works that'll be fun and hopefully out next summer or in the fall time. Again, we just did the Shareholder Yield second edition, which listeners, you can ping me about if you can't find it. But yeah, that's kind of the roadmap for the rest of the year and into 2025.
Speaking about 2025, obviously when you're a fund issuer and you've got as many funds as you do, you want to be careful sort of making market calls because, first of all, nobody knows what tomorrow's going to bring, me included, you included, everybody that's listening. But, you want to give a chance for all your funds to really work, and you don't want to kind of favor one over the other. Having said that, I still want to get your outlook on next year. A lot of hype around Trump and reinvigoration of the economy and growth and all this. I am a bit skeptical that the hype is going to play through, but I want to get your thoughts on what you think about next year.
Sure. There's kind of a couple broad themes. Longtime listeners will know that, half our brain is value and half is trend. The trend right now is everything's up, right? I mean, stocks are up, foreign stocks are up. You got precious metals up, you got Bitcoin up. It's bull markets and many, many things. Now there's some things not bull markets, fixed income, right? Not bull market, but on average, it's a pretty romping, stomping period in many type of equities. That having been said, U.S. stocks, no question, are expensive. To me, over the years, we did a tweet yesterday where I like to talk about 10-year PE ratio, and I don't think your valuation metric matters. But I think when something's expensive or cheap, they all should say the same thing. And so we did a tweet yesterday from Luthold Group. They put out this monthly green book, which is my favorite read every month. And it says, I said, no matter how you measure it, foreign stocks trade at half the valuation of U.S. stocks. And so this is on 12-month trailing EPS, 5-year average EPS, price to cash flow, price to book, price to dividend, doesn't matter. Foreign stocks are about half, and you can throw emerging markets in there too. Now, the question is, does any of that matter? And no, it doesn't really matter till the trend changes, right? So U.S. stocks are absolutely crushing it again this year, up 30% or whatever we are. But on average, the first 2 years of a presidency, the stock returns tend to be muted. The line in the sand for me has always been a CAPE ratio of 40. So I was like, you can't really talk bubble in my mind. Like I like to use 40 as sort of the line in the sand, and we're pretty darn close to peeking our head above that number. I think we're at 38, 39 right now. So if we end the year at 40, I have an old tweet that was very unpopular or popular, depending on your point of view, that talked about future returns if a stock market ended the year at 40. And I think it was like never in history has there been a period where stocks had future returns above average after they closed the year at a PE ratio of 40. I'll have to dig this up to find it, but it's no matter what, it's high, right? So and you've had this a bunch. You had this in 2007. India and China were both above 40. China now is at like 12. I think India also is diverged for the first time. Long-winded answer. U.S. stocks are expensive. We love value. We love quality. So shareholder yield to us is a screaming spread versus large cap expensive stocks. But to me, it's a yellow flashing light. It's not a red flashing light until the trend rolls over, which is not yet. It may be next week. It may be next month. It may be in 2030. Who knows? But it's where we are now. The biggest dislocation I see, which is still curious, and I don't know that anyone else really talks about this other than me, is the whole fixed income yield spreads right now. It doesn't make any sense to me. Where historically T-bills, if you invest in risky bonds, historically they have a higher yield than T-bills, and doesn't matter which one you look at currently, corporate, junk, 10-year, 30-year, on and on. There's not much juice, not much squeeze in that juice. What's the phrase? Not much juice in the squeeze. Not much juice in the orange, not much squeeze in the orange, whatever it is. There's not much yield spread, and you see these charts where it's like corporate bonds, tightest spread in 30 years, whatever it may be. Historically, it's kind of like value investing in stocks. Doesn't make a lot of sense historically to invest in stocks when they trade at 10 times revenue. But there's periods where it may last a year or two or even more, where you have this face ripper where the expensive stocks just go nuclear and they go right back to losing a bunch of money. And I think the same is true with bonds, right? If you're not getting that margin of safety, you're not getting paid to take on the risk. Historically, that's been a really bad idea. So either T-bills need to come down, the entire curve needs to go up, or both to kind of normalize. But that's not where we are today. So I think that's an oddity. And then we love foreign and emerging market stocks. I think emerging markets are probably my favorite as far as something that's cheap in an uptrend and totally hated or forgotten at this point.
Can I ask you on this credit spread point? So there's this interesting thought experiment, which is that maybe the reason spreads have been so tight is because in general there's a degree of vol suppression in the equity space because of the proliferation of all these covered call strategies that are basically selling into the vol. So there's a very strong correlation historically between the VIX on the equity side and credit spreads on the bond side. VIX spikes, credit spreads blow out. You see that it's almost a one-for-one relationship. And we've seen volatility generally has been pretty low on average. Every time it looks like it's going to go, it's like whack-a-mole, immediately comes back in. Is there any? I mean, I don't know. Do you have any response to that? The idea that maybe some of this is just because the structure of markets is changing when it comes to volatility dynamics?
Yeah, I tend to agree with you. And I think the challenge is what happens when there's like a big regime shift, is like you can have these shifts and who knows what's going to cause it. I don't know. But you have a shift and all of a sudden, it snowballs the other way. And so how long this can continue, this is why we're trend following at core, right? And we probably have the largest trend following allocation of any advisor in the country, which our default is half in our Trinity portfolios. Then there's lots of different ways you can do trend, but on average, I think it historically is my favorite style of investment to complement with a buy and hold portfolio. And so, when these type of shifts change and can occur, who knows? I mean, we say the markets can always move so far. It's like a rubber band. Japan, we love talking about Japan in the 80s. The 10-year P ratio went almost to 100. So that's double where we are today in U.S. stocks. But then the rebound is going to be that much more dramatic or long. And so, when we hit 44 in the late 90s, it took 2 bear markets to clear that out. So who knows how long it's going to take and when it's going to happen. Maybe Elon AI 2.0, is this industrial boom that lasts for years. We'll see, but that's where the trend part comes in, and it'll start to give us those signals, which is not yet, right? It's not yet. We said this in Barron's a couple weeks ago. If you guys saw us in Barron's, we said there's a quad box, which I'm not sure if I said, but maybe I probably did, where if you put U.S. stocks, cheap, expensive, uptrend, downtrend, the best is a cheap uptrend, and second best is an expensive uptrend, which is where we are now. So a totally fine place to hang out. The problem is expensive uptrend to expensive downtrend puts you in the worst quadrant. And that's where things can get kind of dark and unpleasant. But again, not where we are now across really any of the U.S. indices. But that can change on a dime. And what causes that? We'll find out. You and I will do a show and talk about it. But for now, TBD.
Is it fair to say that fund issuers would prefer to see more volatility than not. I say that because, to grow a fund, you need to have money in motion. To have money in motion, you need either new money or some fear. That new money tends to go into what already people have allocated to, because that's what they're familiar with, and it's been good to them. I mean, do you think that we just in general need volatility to see some real explosive growth in the industry?
I was quite proud of myself. I went on CNBC, and I, people love to say, in these uncertain, volatile markets, and whenever I went on, and who knows, it could have been Bloomberg, but it was a period of just long, low volatility. There's no way you could have said that the markets are volatile. And so I was quite proud to say, look, in these low volatility, certain times, and then it followed on with whatever I said. I've always wanted to say that, because everyone just says that these highly uncertain, volatile markets. I'm like, these volatile markets aren't volatile. It's like a VIX of like 12. Like it's like the most copacetic and chill period I can remember. But that's not always the case, right? And like, if you look back in history, so one of these books we're writing is a coffee table book on the history of stock markets. And, the chart that every financial advisor loves is the stock market chart over time, and it just goes up into infinity. And every year is overlaid the crisis event. And so Vietnam, Pearl Harbor, Spanish flu, COVID, whatever it was. And yet you over time still get that compounding. Who knows what's next, but certainly there's always some negative geopolitical shocks at some point. Now, most of the world is pretty cheap as far as stock markets. We're only one country out of roughly 45 investable countries. U.S. is only a quarter of world GDP. I feel like that always surprises people. Emerging markets are actually a majority of the world's GDP. So there can be these shifts, and what is once dear becomes hated. I mean, look at Chinese stocks. 2007, everyone on the planet wanted Chinese stocks, the BRICS. That was the acronym of the day, as opposed to today being AI and everything else. BRICS. And Chinese stocks, I don't think they've had positive returns for 30 years now. Like, it's some astonishing number. I saw today for the first time, Chinese bonds yield less than Japanese bonds. Like, who would have thought about that? That's crazy. But so you have these regime shifts that can last like an entire career. It for many of us, 5-10 years feels like 40 or 100, but then eventually things shift and things change. So the volatility hasn't been as much. And I think, the US markets, 2022 feels like a distant memory, 2020 COVID. But once again, we'll have, the highly volatile periods, and some things will break, and hopefully we can survive that.
Meb, for those who are intrigued by the TAX ETF, and for those who want to learn more about what you do, where'd you point them to?
Cambria funds for the ETFs, Meb Faber blog for blogging, Meb Faber show for the podcast, the Idea Farm for a weekly curated research piece. By the way, we just put out some of our top podcasts of the year, curated by my team, not me. And there's a Spotify playlist that goes along with it. So subscribe to the Idea Farm to make sure you get that. It's a lot of fun. It's free, and can listen to with some eggnog at the end of the year as everyone reflects. Those are the best spots. And watch me, mix it up with you on Twitter and elsewhere.
Once a month, folks. Appreciate everybody that watched this. Again, this is a sponsored conversation by Cambria. Make sure you learn more about Cambria funds, and of course, follow Meb Faber. And I'll see you all in the next episode. Thank you, Meb. Appreciate it.
Great. Happy holidays.
Happy holidays, everybody. Cheers.